Okay, got the message.
Hello and welcome back to the ROI podcast, the podcast that's obsessed with the art and science of return on investment, how to buy a stock and have it cut in half on you within a week. Amongst other things, it's my pleasure to welcome back the Professor Degen himself. Guys, nothing we say here today is advice. We're going to be touching on some recent earnings, particularly with stocks that we've spoken about. We're going to talk a little bit of macro. We're going to talk a little bit about anything that happens to come up over the course of an hour. Professor Value Degen, how are you doing, sir? What's happening where you are?
Oh, well, what's happening today is Jackson Hole. Jerome Powell convinced everybody that cuts are imminent. And I just wanted to take a moment to remind everyone that Dogecoin has a $16.7 billion market cap. Shiba Inu has a $9 billion market cap. Pepe Coin has a $3.8 billion market cap. Dog with Hat is a $1.8 billion market cap. I mean, that's three times the size of the Argentinian land company I just wrote about that has 750,000 acres of farmland in Argentina. And it would take three of those to equal Dog with Hat coin. And Jerome Powell wants to cut interest rates with the real estate market at all-time highs, the stock market at all-time highs, and Dog with Hat three times as valuable as the largest farmland owner in Argentina. So that's it's just an amazing time to be alive.
It is.
Oh,
We spend all this time on due diligence, and in the end, we could just buy a meme coin and call it a day. But anyway, what would we do with our time? Mates, I'd love to start the conversation, if I may, with a stock that I've had an interesting relationship with. I've booked a lot of profits, I traded in, and then it sold down to around the $20 mark. And I thought, I think it's worth it. I think it's worth adding in a half to 1%
yeah.
position. The stock I'm referring to is New Fortress Energy. A lot of people have been asking me about it. Um, I've gone through earnings. I have a few concerns, and I'm thinking today we can kind of hash them out. I spoke with our friend Chappie last week. He's out of the trade. I'm still in with it because I had a small position. What's happened with the earnings, and why has this thing just absolutely plummeted down almost 60% over the course of the last 12 months?
Yeah. Well, the number one reason why it fell is because I bought it. Because everything I touch gets cut in half immediately the very next day. Only half joking with that one. No, the day that I wrote about it, I think it was $25 a share. It had just climbed up from $22 a share. I was like, well, it's getting a tiny bit more expensive, but it's still fundamentally sound. And then it gets cut in half to $12.50 a share. Um, so the last earnings call, they had gone from having an EBITDA of 325 million the prior quarter to 100 million. So their EBITDA got cut by 2/3. And I don't think I'm hallucinating this. I think that my understanding from the earnings call was in the transition from this is about the Puerto Rican power plants. So they built two power plants in Puerto Rico on behalf of FEMA, the Federal Emergency Alphabet Agency. And within that contract, there was a clause that the Puerto Rico Power Authority could buy those power plants whenever they wanted. So it was a 2-year contract, but the Puerto Rican Power Authority had a right to buy them. And 1 year into it, the Puerto Rican Power Authority did buy them. But then separately, New Fortress Energy won a 4-year contract to supply natural gas to the Puerto Rican Power Authority. So between the roll-off, so these power plants were operational. New Fortress Energy is supplying natural gas to them the whole time. There's no interruption of the business process. I think what happens is the Puerto Rican Power Authority had terms. They had 3 months to pay. So you have a quarter with no income. I think that's really the only thing happening there is just that there's a change in payment terms and you have a quarter with no income. You've got a fundamentally good business that is operating and they're doing a good business, but you just have a delay in receivables. I think that's really the only thing going on. And they guided toward 275 million of EBITDA for next quarter. I think that's just the delayed reaction of the power plants that are operating and they are getting natural gas delivered to them. And New Fortress Energy is going to be making money hand over fist off of them. So I think that was really the big scare. And if you listen to earnings calls, it's you understand what's happening. But if you're quantitatively driven and you see 300 turn into 100, that's pretty terrifying.
So let's unpack that. What I don't like about it, my idea was I really wanted to keep the control and the ownership of the power plant. In the long term, that's what I would prefer. However, it is what it is. They're going to receive the cash, we think, within a quarter. The market is somehow acting like they're not going to receive that cash, or they don't understand that they're going to receive that cash. And the question is, moving forwards, they're now selling gas. That doesn't give me the warm and fuzzies. The gas market's not a market I really love. I liked being on the other side where they got the cheap gas, they turned it into watts, and then they sold watts to the grid. How much can they make over this 4-year deal selling the gas? And let's, after that, talk about some of their other projects.
Well, this is what's so amazing, and this is why I know there's a lot of complaints about executive compensation and CEO pay, and there's a lot of very reasonable complaints about that because a lot of CEOs that don't deliver. This has to be one of the most magnificent performances by a CEO of a company that I've ever seen, because if you take something like Peabody Energy, in their presentation, you can see what their costs are of everything they do. They'll tell you in the Powder River Basin, it cost them $11.50 to provide a ton of coal, which is, by the way, just an amazing cost structure. But then the people they negotiate with says, okay, well, I'll offer you $13 for it because I know what your costs are. New Fortress Energy doesn't do that. They don't tell anybody anything, which is one of the frustrations of shareholders. We don't know how much money they're making from Jamaica or Nicaragua or Puerto Rico. But because people don't know what their costs are, the CEO, Wes, goes to Puerto Rico and says, I'll save you 25%. Is that a good deal? And Puerto Rico says, well, yeah, it is a good deal to save 25%. That's a fantastic deal. Puerto Rico is running 60% on burning diesel for electricity. And diesel is some of the most precious hydrocarbons there are. I mean, it's stable at room temperature. It's energy dense. And burning diesel for electricity is like almost borderline sinful behavior. 1 MMBTU of natural gas, which is like $2 right now in the United States, that's the equivalent of about 7.5 gallons of diesel. And the gallons of diesel sell for about $3.50 each. Take 7.5 gallons of diesel at $3.50 each. Take that number, shave 25% off of it, and that's what New Fortress Energy is going to be selling their natural gas for the next 4 years. I mean, I only wish it was a 10-year contract instead of a 4-year contract. But that $175 million of EBITDA a quarter for 16 quarters, my brain's working a little slow right now, so I'll let the calculator do the work for me. That's about a $2.8 billion contribution to EBITDA from one contract in Puerto Rico. And that's for a company that I think that's bigger than their market cap right now.
Yes, it is.
So,
yes,
yeah, so 2.6. So they're going to earn in profits from Puerto Rico over the next 4 years more than their entire market cap. And then Brazil and Nicaragua and
these
Jamaica
contracts
is just
are fixed
gravy.
price?
The fixed price is 25% below the cost of equivalent diesel.
Okay, so...
And then they hedge with derivatives the price of diesel. And then the analysts on the call were like, why are you getting derivatives against diesel? And they were like, well, because that's how the contract is, you know?
Yeah. That makes sense. It makes me feel a little better. So management's guiding still over the next financial year, adjusted EBITDA expected to be within 1.4 to 1.5 billion. Where's that going to come from? That's what I want to know. So you might have, we're thinking, what, 380 million in payment for the sale of the power plant. Where's the rest of it? Where's that sort of 1.2 billion coming from?
So the first quarter of the year, they did 325. The second quarter, they did 100. And each of the 2 final quarters of the year, they're guiding toward 275. The FEMA contract was bigger than the Puerto Rico contract, but the FEMA contract contained some of the costs of building in it. And the FEMA contract, because it was canceled early, the New Fortress is going to receive a residual payment from that process. Now, it's a government process, so nobody knows how long it's going to take, but they were the successful winner of that government contract, and they were prepared to deliver the natural gas for the whole year. So there's this agreement to deliver this to the government. If they took the government to court, it would be worth something like $1.5 billion. But there is a pretty standard reconciliation process where the government contractors and agree with the government, say, okay, we're going to take all of your costs, we're going to tack on a reasonable profit, like a cost plus contract. So when this contract reconciliation process goes through, New Fortress is estimating, and they have a consultant that helps them with this. This is not their internal numbers. They rationalized it with an expert in the field. They think it's going to be $671 million for the remainder of that contract, which is, you add on to that the money they received for the power plants from Puerto Rico, and that's the full payment for that FEMA contract, the extra year's worth of profits, plus all of their mobilization costs. So in a way, they're going to get paid for this year twice. They're going to get a year's worth of profits from FEMA and a year's worth of profits from Puerto Rico. So it's
so that's because there was 2 years left on the contract, and then they have to be compensated for the costs of constructing this thing in the first place. So they're not gonna realize a loss on the construction of this power plant. They're going to be compensated for
that's
that
right.
with a.
Now,
a
people
little,
are panicking on Twitter saying, oh, they're not going to get paid, or they're going to get paid less than that. Who knows? Maybe it's true. But the US government is not known for going around and screwing over their defense contractors. Once you have a contract from the US government, it's supposed to be as good as treasury bonds. So that this seems, now the timing of it, who knows? Because governments do move slow. But the amount, I would be surprised if it deviated much from what they said it was going to be, because it's a cost plus contract. I mean, it was there for New Fortress Energy to build the power plants, which they did, and then to profit off of for 2 years. So they still have those profits coming to them from that contract. And if FEMA didn't want to pay it, well, you just take them to court and get $1.5 billion for the completion of the contract. So
yeah, that seems quite reasonable. I think the event of non-payment is highly unlikely, and we maybe that's why we're lowering interest rates from the Fed to be able to pay FEMA. Yeah. No, I'm just kidding. Okay, so that seems reasonable. In terms of moving forward, though, so we've got our 16 quarters, you said, worth of gas payments to Puerto Rico. We've got, I don't even want to mention fast LNG. So I'm going to talk about Barcarena, the auction in Brazil that's supposed to be coming online Q1 2025, last I checked.
I thought it was this fall, but I could have the date wrong. But it is an imminent power auction where New Fortress expects to get paid for capacity, right? Just if you're providing base load power for the grid in this era of renewables, you get paid for capacity. Then if you actually provide the power, then you get paid for that too. So there's two separate payments, one for capacity and one for actually providing the power.
Yep. Okay. And how much is that going to be worth on a standard yearly basis? And is the same kind of thing likely to happen down in Brazil?
Oh, so I haven't crunched the one in Brazil. I think what struck me about it is the terms were for something like 15 years. I might have this wrong, but it was a very, very long-term power supply contract. And the plan was to, once that's in place, to do an IPO in Brazil and let the locals enjoy some of the gains from that. Do a partial IPO in Brazil of the Brazilian subsidiary and let the Brazilian stock market participate in it. And that would be a liquidity event to maybe settle some of New Fortress Energy's debt. And they also want to do an asset-based financing of the fast LNG so they forget it cost them $2 billion to build, but now they value it at $3 billion, and they wanted to have it 50% leveraged. So they want to do an asset-based financing for $1.5 billion on the fast LNG, and then I think split that between retiring debt and return capital to shareholders, which I'd rather have them retire a little bit more debt, but they did specifically mention using some of that money to return capital to shareholders, because New Fortress Energy did have more of a return of capital to shareholder program until they decided that they wanted to, push more aggressively into growth. They still want to push into growth. It's just what they're promising is that they have the capability to do more asset-based financing, that the growth won't come out of their own cash flows. There's 100 million more of growth to come out of their own cash flows, but everything else, the growth will come out of asset-based financing. That the stuff will finance itself by then. And it'll be like a capital light business after that.
Yeah, and that's was my original thesis, and I like it because generally speaking, with that asset secured finance, you can obviously obtain much better rates. Looking at the details on my notes here, it's been a while since I reviewed, but the power plant contract, it is a 15-year capacity reserve, 1.6 gigawatts of the gas-fired power plant. And so, I mean, that's what I'm playing for. That's what I would like to be involved in, is to be able to have that highest end of the value chain. So over 15 years worth, that seems to be a pretty straightforward a case for revenues, most of which will drop to the bottom line, far in excess of the current market cap. The question that I have left, and you alluded to, is what's management gonna do with the earnings? You posted a lovely meme in your article around some of the discipline of natural gas producers in the US, well known for their capital allocation strategies. Is the same thing likely to happen into this in this company? I don't think so. I mean, Wes owns an enormous. He has an enormous amount of skin in the game. Surely, eventually, he's going to want to pay himself a dividend, right?
Yeah, and that's what the I'm not super fond of returning capital to shareholders through the debt restructuring. I'd rather have that be, just wait a year and have it be really from profits. But that is their plan, is to start returning capital to shareholders from some of these debt refinancings as they move to asset-based financing from corporate level debt, which also should lower the interest rate a bit. But I mean, they still have a lot of growth plans. They want to turn Nicaragua into a local hub capable of exporting electricity to some of their neighbors, and some of their neighbors are still burning diesel for electricity also. So there's going to be a lot of growth opportunities out there. And now, to be fair to your friend on the last podcast, Chapman, when a company starts having a bad earnings call and tries to, do the Toreador thing with the red cape and distract everybody with the next big hot thing, that should be a red flag. And so they did say on the earnings call they're going to start focusing on natural gas power generation for the artificial intelligence build out. And that is a textbook red flag. They miss earnings, and then they start talking about some new hot thing like AI. In this case, though, because the Puerto Rico situation, the business is still ongoing. It's really just the payment terms of the new client. And also, I was kind of shocked when I was reading some of the details of the power plants that they built in Puerto Rico. I think one of them was built in 28 days. Did you see that, or did I hallucinate this?
No, it was pretty impressive. It was like a Chinese efficiency of a power plant built.
They're building a Starbucks at the end of my street. It's been going on for a year and a half. And they built, a multi, how many megawatt power generation capacity in 28 days. It's just shocking. But for the data center build out, the utilities are telling data center companies, yeah, we'll give increased power supply in 3 years. So now the data center companies want to front run or go around the utility companies. And utilities are a big AI play. We saw a huge utility rally on this increased electricity demand. But they might not participate if companies like New Fortress Energy just builds a power plant attached to the data center, which they can do because they can build a power plant in 28 days. That is just unheard of. So it is typically a textbook red flag if somebody misses earnings and then talks about the big new hot thing. But again, I think they missed earnings because of the payment terms of the new client. And it genuinely does make sense that if the utility company says 3 years and New Fortress Energy says we'll do it in a couple of months, and they have a piece of land in Pennsylvania that they want to do it on already. So I don't know how long they've been planning on this, or if they just have assets that they didn't know what to do with anyway, but it seems like they want to move pretty quick. And because of the mobilization for the FEMA contract, I don't know how familiar your listeners are to these natural gas power plants, but a coal power plant and a nuclear power plant are very similar in that they both just boil water. They're water boilers to spin a steam turbine. But a natural gas power plant, it's like an airplane engine, but vertical. And those turbines, they wear out, right? The coal power plant, this boiling water and spinning a steam turbine, those things last for 100 years. But the natural gas power plant, they cost half as much to build, but you have to keep on replacing these jet engines over and over again. So the engineering companies like Siemens like it because it's a razor and razor blades business model. We keep on selling more and more turbines. Well, because they had acquired the turbines to satisfy the FEMA contract, they have a warehouse full of turbines to start building out a natural gas power plant for a data center. So they even already have the equipment to do it, which they're supposed to be reimbursed for when the FEMA contract consolidation reconciliation process goes through. So it is kind of interesting. Again, textbook red flag. We missed earnings. Here's a shiny new thing we haven't talked about before. But in this case, I think it's the what is that? The example that proves the rule sort of thing. It's a counter example.
Yeah, and there's a big difference between like a big electricity power plant and data center power plant, I would imagine. I don't think they're on the same kind of scale. I could be wrong on that.
Yeah. I think it'll be a tiny bit smaller, but not even that much smaller.
Okay. Well, that's interesting.
But the important thing is it's on the natural gas pipeline. So, you've got access to the piped gas. So, and again, with the utility companies saying 3 years, because that's the speed at which utility companies operate, it's, New Fortress has a chance to move in there and be quick about it.
Yeah, indeed they do. And in terms of the CEO alignment, so Wes owns basically a quarter of the company, and the value of the shares he owns is still, after a 51% drawdown, 609 million. The guy's got skin in the game. I mean, maybe 609 million is not a lot to him. To me, it's about half of my Dogecoin holdings, but so I'd probably miss it if it went missing. So you think that the guy is aligned in terms of eventually getting to this point where the capex stops and the funds start flowing to the degenerates downstream, like ourselves. So let's look out maybe next year, the year after that, and they've got the gas contract in place, they've got the Brazilian auction in place. What do you estimate their EBITDA to free cash flow 2 years out? What can they do there?
This is hard because there's so much stuff going on, and they also can operate at breakneck speeds. That, of course, comes with a cost. So their land-based liquefaction terminals in Mexico, they say they can get one of those operating in 3 months. And in May, they said they could have it up by August. Oh, it's already August, so I don't know if it's at what speed they're going to build these things. But that's two more liquefaction terminals. You also have Puerto Rico. And another aspect, just responding to Chapman Scarborough, one of the concerns was, well, are these power plants going to be operated? Are they really going to get paid to deliver the natural gas? Well, Puerto Rico prioritizes things based on the carbon intensity of the power source. So the natural gas plants are going to come at a priority over all the existing diesel plants. So these first ones should be operating at 100% capacity for the whole contract. Puerto Rico also has, when they lined out all of Puerto Rico's power capacity, there's a couple low-hanging fruit power plants that could be converted for about $100 million. So phase 2 in Puerto Rico is for them to go back to Puerto Rico and say, look, sign another 4 or 5 year contract we'll save you 25% of the costs. We'll pay $100 million for a 2.8 billion contract. You pay $100 million to convert the power plants. We'll convert them, and then we'll supply the gas for 4 or 5 years. So that could happen, or it could not happen, because they were negotiating with Puerto Rico for years before anything happened. So Puerto Rico could just be dragging them along until it becomes necessary. So there's too many things that might or might not happen to really put a price on these things. Just that at some point you say, look at the skill of management in landing that contract. Being able to go to Puerto Rico and say, I'll save you 25%, and now selling, I have to guess, it's some of the most expensive natural gas on the planet right now. I mean, it's I think more than twice the price people are getting in Europe. And Europe has the, you can cut off from Russia prices. So this is, you see skills from management like that. And at some point, the amount of things you can know by digging deeper gets harder and harder to figure out. And you hit your caboose the management's train and hop along for the ride. There's the situation in Brazil. I mean, landing a 15-year contract there is huge. Then who knows what they could raise from IPOing half of it down there. There's, potential expansion in Nicaragua. There's a lot going on. Who knows if they get any data center contracts. But if they can build a power plant in 28 days, and we're going to talk about what numbers are going to look like next year, they only guided to the same EBITDA as this year. So in their guidance, they've included none of the upside. They said, okay, which you want people to do in finance. You want them to give you a moderately conservative estimate because you don't want people blowing sunshine up your skirt. And I think that's reasonable guidance. So they've guided only for next year being the same as this year, but then there's so many things that can go right for them.
Indeed. So if this thing can do, from probably the two main income generators at the moment, at least, $1 billion to $1.5 billion in EBITDA fairly consistently over the next few years, you earn, I know earnings, EBITDA earnings are not the greatest source, but you're earning your market cap back in a couple of years with a call option on all these other things that you mentioned. Debt distress, this is not a distressed company. They don't have any real maturity walls coming up that is going
what's
to
the
sink.
interest expense? 266 million in the last 12 months. And that's for something with an, EBITDA run rate of, over $1 billion. So that's, less than a fourth of EBITDA for interest expense.
Exactly. Yeah.
And the balance sheet, they have a lot of debt for all these assets, but it's just a lot of assets that haven't been, it's like that anime. You haven't even seen my final form yet. There's still a work in progress, but all of the progress is really, really good. It's like every step along the way, some people in business talk about, the pizza, you've got the dough, you put on the sauce, put it in the oven, like you can smell the pizza cooking and it is a delicious smelling pizza. I have all the evidence that things are going really well and they do smart things and they make really great things happen. So when the pizza comes out of the oven, it's going to be good. I just don't know what it looks like yet.
As long as there's no pineapple on it, I'm willing to take a bite. Moving
The
on,
Canadians invented that. Everybody think of Canadians as friendly, but they put pineapple on pizza first.
Nothing good comes north of the border. I'm convinced of that. A lot of rain. Anyway, let's talk about, what should we talk about? Should we go there? Should we go there? B. Riley. The B team. Is the B team running B. Riley? Or what's happening over there?
Yeah, so this is I had two really strong conviction stocks that, and I got into them even before the short started attacking them, and then the short started attacking them. And then I look at the short thesis, and the first one of the two is Medical Properties Trust. And this one, the shorts who are attacking it, they're using the same playbook, but they're less skilled at it. The shorts attacking B. Riley are really good at their game. I mean, hats off to them, but they're very good at what they do. The shorts attacking Medical Properties Trust, they're not quite as skilled at it. And it's also, I had thought of it from the framework of, okay, what's the truth? What's the real value there? And you see these shorts, whenever you try and engage them in a conversation about trying to get to what the truth is, they block you immediately because they don't care what the truth is. They want the stock price to go down.
Well,
and then they write on
year to date. So
oh yeah, well, B. Riley is really in the toilet. But with something like Medical Properties Trust, the shorts don't really have the ability to hurt the business because they're the landlords of hospitals that have 20-year master leases. So no matter how many times a short writes fraud on Twitter, if they write it 10,000 times a day, they have no ability to impact the fact that their hospitals are fully leased out with 20-year master leases, and you can't really hurt the business. It did hurt their financing terms. I mean, there's so much negative sentiment that if they had to refinance any of their debt, the interest would be, pretty punitive. But they've got plenty of cash for their debt maturities. So that they raised $2 billion this last year through some asset sales. But B. Riley is different because B. Riley, and as a financial firm, has counterparty risk. So if you want to choose an investment bank to do your IPO, do you want to choose Jefferies or Stifel, or do you want to choose this company that has people on Twitter writing fraud 10,000 times a day about them? So the shorts do actually have the ability to hurt Riley's business, and they have. So B. Riley was a bit over their skis on leverage in a take private transaction for the franchise group. And they knew it was too much leverage, and they had the plan to immediately sell off a couple of pieces of that group, especially Vitamin Shop. So Vitamin Shop is it's a franchise, little standalone nutrition supplement store, like a physical location for Herbalife. I mean, it's not a fantastic business. I wouldn't try and pitch it, but it's a very decent business. The one in my mom's hometown has been there paying rent for like 30 years. So again, it's not a fantastic business, but a very decent business. And they kind of hinted on the last conference call that, yeah, nobody wants to buy this thing, while the frauds, the people on Twitter are saying fraud 10,000 times a day. So without the ability to sell that asset for a reasonable price, they can't retire the 16% interest rate debt that the franchise group has. And it just keeps spilling over and causing problems. So that is really something I was trying to get to the bottom of. What's the truth about the business? And that's not what the shorts are doing. That was never their game. Their game was, how do I get the stock price lower, and can they destroy that business? And so the stock price recently is down on an announcement of an SEC investigation. Well, and there was one last January also. I listened to one of the Twitter spaces from some of the short sellers, and the short seller was like, yeah, they investigated because I contacted the SEC every day for a month until they agreed to open an investigation. So, I mean, the shorts are causing not just the price to go down, but I mean, how much business does that cost them for underwriting? Do you want this company to underwrite your bonds? Do you want this company to underwrite your equity offerings? So it really is a huge difference between medical properties trust, where the shorts can't really hurt their business in any meaningful way, and B. Riley where they can. And I didn't see that. So that is the mea culpa. Now, I still like B. Riley. I bought more at like $6 a share. The one of the short theses was that Bryant Riley, the co-founder and chairman, he has a credit line. So his shares of stock are collateralizing a credit line, so like a margin loan. And so they thought, if we get the price low enough, we could force him to sell. But it turns out he has other assets collateralizing that credit line. And not only is it not going to force him to sell, but he made an offer on the whole company. So I'll just take it private at $7 a share, which didn't even move the stock price, which is kind of amazing. So that's a real risk. You buy it at some price above that, the shorts drive the price down, and then the founder just takes it private for pennies. I mean, that would turn Bryant Riley from, a multi-hundred millionaire to a billionaire, to take the company private for $7 a share. And then a couple years later, when the shorts have forgotten about it, to take it public again.
Because he could underwrite his own IPO.
Exactly, really. Because that's their core business. And my hypothesis is that the risk of companies going private, this is happening to Forward Air also. An activist investor that has, I think, 22% of Forward Air wants to take it private. They're like, oh, the retail investors don't understand you. Just come with us. We understand you. Like, we'll just keep all the upside for Forward Air. It's at about $31 a share now, and I think I wrote about it when it was closer to 19. So it's done very well. But I want to enjoy it till it gets back to 100. The threat of being taken private is always there. I thought it was relatively safe for that from B. Riley, because they have to keep providing all this information to the SEC for example, they issued baby bonds. Just create a ticker symbol and issue your own bonds. It's a very powerful tool for them because they're a market maker. They can do this sort of thing for themselves. So I assume that they just wanted to keep on staying public and providing all that information to the SEC. They said, no, we'll keep on providing all this information to the SEC, and our bonds will still be publicly traded. Just we'll be private at $7 a share. So we'll take this company with, I think in my Substack, I calculated somewhere between $2 and $3.5 billion of assets if they wait until the next boom cycle and exit at good prices, and they'll take it private for like 150 million. It's just terrible.
Current market cap 184 million. So you're thinking, look, ballpark figure, if you did an asset valuation, that's maybe a couple of billion, and the guy already owns 25% of the company, Bryant Riley.
And he has his shares of stock are collateral in an account with other stuff, because remember, this company in 2021, it paid $12.50 a share in dividends. So that was a huge chunk of cash. Who knows what else he bought with it and what he has, collateralizing his slush fund to be able to buy. But he could just single-handedly write a check for the other $140 million and take the company private, which means the shorts would make money and Bryant Riley would make money, and all of retail would never participate in the upside. And that would be really frustrating. So that's rough. But maybe it's a little failure of being too academic, but I thought I was focused on, what is the business worth? What can this business do? I wasn't really focused on, these shorts are very good at their job and they could actually destroy a company if they put their minds to it, because it can cost them business, just the fog of it. And it's pretty amazing. And there was even more drama. So while they were shopping around Vitamin Shop, they announced earlier this year they were going to sell part of their liquidations business, the Great American Group. And this is a company they had bought for $35 million. It might have even been a merger. I think it was either that or another. When they went public for the first time, several of their C-suite executives came from Great American Group. And I was surprised that they would consider spinning it off. And this one was really a smart move. Howard Marks's Oaktree is going to buy a 55% equity. This is a rumor but from Bloomberg, so maybe a credible rumor. Oaktree is going to buy 55% of it, valuing the entity at $380 million, but then RILY gets to keep it. So one of B. Riley's business model components is all these financial services companies create constant referrals for each other. And I was surprised that they were looking to sell a piece of their core business, because the goal is to have this giant wheelhouse that creates this constant stream of circular referrals. So I was shocked they were going to sell Great American Group, but they're going to sell 55% of it, passively to Howard Marks's Oaktree, but keep it and operate it. So that was kind of solved the riddle of why they would sell this thing. And if they value it at $380 million for the whole thing and sell 55%, that's a couple $100 million and they can buy back their own debt at, I don't know, 70 cents on the dollar right now because the debt's so depressed. So that if it goes through is pretty, I mean, it should make the parent company more valuable, but it doesn't reflect in the stock price at all. There was a squeeze. So when that was announced, there was a bit of a squeeze from $5 a share up to, I think, $8 a share. And now it's right back down to $6 a share. So yeah, it went from $5 up to $8 and now back down to $6.20 something. But the short interest on this thing is so high, and it has so many assets.
Yeah. So the 52% short float, what I'm looking at currently.
Yeah.
And yet you're telling me that one of its subsidiaries, it's going to sell a 55% stake for twice the current market cap effective valuation.
Yeah. And that's, I mean, they have their apparel brands, 46% of Hurley and 41% of Justice. They've got a bunch of apparel brands. That does about 50 million a year in income, just pure dividend with no cost associated with it. I mean, one of the things that they could do is they could just do a spinoff. They could create a new entity with all the apparel brands, spin it off, which then the shorts would have to buy that because they're short the whole thing and they would have to buy it. They could, the lenders, the Nomura is the one that has lent RILY a big chunk of money on their credit agreement. The lenders don't like having all these fraud accusations at one of their big clients. So they would probably be thrilled if some of that debt was transferred to the subsidiary. So you could take all the apparel brands, maybe give it $300 million of debt at 6%. Nomura would be happy that that debt is now on a more creditworthy entity. They could spin off half the shares, and then when the shorts have to buy it, they could sell more shares into the shorts buying, and maybe keep 30% for good measure, and relieve themselves of $300 million of debt. And the telecom business is in the same category. The telecom business has $50 or $60 million in income. They could give that $300 million of debt, spin off half of it, make the shorts buy it, and then sell another 20% into the shorts. There's so much they could do. And these guys are smart. They've been doing it for 27 years. But I, really did make a mistake thinking that the shorts were, and listening to this Twitter spaces with some of the shorts, because two of the people who are short this are from the movie The Big Short. Two, very famous people that had actors play them. Okay. And their short thesis was, look, the assets versus liabilities don't make sense. And now I went through line by line at all the assets, and I thought it did make sense, but that's a reasonable disagreement. But there's other shorts who are just, writing fraud 10,000 times a day on Twitter and just genuinely trying to destroy a business. And it is, I'm surprised that they get away with it, but typically when a company sues shorts, it usually doesn't work very well because of freedom of speech. There have been a couple landmark cases where shorts were sued successfully for very large payouts, and this seems like the sort of case where that could happen, but it's very hard to do.
I can see a case.
And then the SEC recently arrested the guy from Citron Research, who was a famous short seller, because it was just obvious market manipulation. And so they went after him, and I don't know how many years in prison he'll get for it. But this is it's just bizarre behavior. But the guys that are relatively famous from The Big Short, they had a very just reasonable argument. Assets versus liabilities to them didn't make sense. To me, it did make sense. But it's a totally different game when you're, just actively trying to destroy a business. And you can, because the financial firm is based on trust. And if you do a little due diligence, say, oh, this isn't the too hard bucket, I'd rather just use one of your competitors. Now, to counteract that, they've been in business for 27 years and they have a lot of relationships. So people that they've done business with in the past that, I don't know how far that goes compared to, being probably unable to get any new clients because of this fog that surrounds them. But it didn't scare Howard Marks away. So maybe he had known them from dealings in the past. But a company has been around for 27 years, and they have some pretty legit executives. So their head of strategy was on a podcast recently with it's called The Compound. The guy's name is Downtown Josh Brown. So the B. Riley head of strategy was on that podcast not too long ago, and he was a former board member of the NASDAQ. He's been around forever, and they have a lot of very seasoned executives with a lot of experience, a lot of relationships. So I'm not counting them out. I bought more shares at $6 a share. It's just a frustrating situation. And Medical Properties Trust price never even got close to that because the shorts just don't have the same power to destroy their business. Their hospitals are leased for 20-year master leases, and there's just nothing you can do about it.
So wrapping up RILY, in terms of how one might play this, the biggest risk, I guess, in any investment case is a zero, a bankruptcy. The assets and the liabilities, I mean, they're at a par currently, at least when you just look at the pure what's been accounted for. And a lot of their assets are kind of off balance sheet in the sense that they're these private franchise groups that you don't necessarily see the true value show up on what's accounted for on the balance sheet. Do they have any debt burden, any debt pressure?
So they have baby bonds issued, which the maturities are, most of them aren't even that close. But they have, and this again, the reason why and actually I was looking at so one of the famous shorts has a hedge fund for shorting, and I downloaded his prospectus and read what kind of companies they're going to short. And it didn't say that they were going to try and short companies that were mispriced. They said that they were going to try and short companies that were opaque, companies that are hard to analyze. And because they can create this fog of uncertainty around them.
Factor, yeah.
And the loan agreement with Nomura is one of those uncertainties. We don't know what the terms of that loan are. That's between RILY and Nomura, and it's in the black box. So we don't really know. Which again, that's what the shorts love, is creating all this uncertainty, because they've been saying for months and months and months, oh, Nomura is going to call in the loan and they're going to have to fire sale everything and then it'll be a zero. But if you look at the Great American Group, that was held on the balance sheet at a $35 million acquisition cost, because book value is always the price you pay, and it can never be marked up. It can only be marked down. So that $35 million was really $380 million, according to Howard Marks. And, who's he to know, right? He's only got how many years of experience in the business. Yeah. So there's other stuff like that.
Distressed debt.
Yeah, he knows something about debt, just a little bit. And also that was probably the most counter-cyclical part of the business, because liquidations, you do more business in bad years, and people are willing to pay absurd multiples for truly counter-cyclical businesses. But there's other stuff on the balance sheet that it's held at one value, and if they sold it, it would be, many, many multiples of that. So if you just look at the book value versus loans, it looks pretty bad. Also, for B. Riley itself, the interest rates are very low. It's the franchise group that has $2 billion of debt, and the interest rates are high. And in the franchise group, some of the lenders just agreed to forego interest because it's a distressed situation. They really, really, really needed to sell Vitamin Shop. And without the sale of Vitamin Shop for $1 billion, their interest payments are really painful. But I think right now the price of RILY is already priced at as if franchise group is a zero, as if B. Riley just threw away. I want to say it was roughly $500 or $600 million in that take private deal. And if that ends up being a giant goose egg, it wouldn't be fun, but RILY would survive. Probably, unless Nomura calls in the loan, which is a black box. But why would they do that? Why would they force a fire sale, which would guarantee that they wouldn't get paid back? It doesn't make any sense.
No, it doesn't. So book value somewhere around 750 a share. Current stock price 6.22 per share. Hard stop. What do you think the sum of the parts could be worth on a per share basis?
So I did a three-part I did a 3-part Substack article on this, and it's paywalled because it was a lot of work because I just broke through all the components. But anybody who thinks I'm worth $5 a month, if they want to see my 3-part Substack, sum of the parts, let me see what I came up with. I think it was between 2.5 and 4 billion, but about 1 billion of that was from the franchise group. So call it, 1.5 to 2.5 billion just for the components of RILY itself, without the franchise group.
Without the franchise group. Okay, there we go. Enough
and I mean,
said.
keep in mind, and you don't know all the numbers for this, but they invested, I think it was between 60 and 100 million in oil and gas rights in 2021 at the COVID lows.
I heard you
I mean,
say that. Took me by surprise. Yeah.
Yeah, but it's in California. Then you have all the California problems to deal with, and I don't know what they're doing, but they haven't sent back so many dividends, so it might just be growing in value. But and oil and gas prices aren't particularly high right now, so all the stuff they sell, they're waiting for a good time to sell. And the problem is if you have to sell in the meantime. If they can wait 2 years for certain segments of the market to recover and sell it at a reasonable price, everything is fine. If they did have to fire sale, yeah, there would be problems.
So you mentioned 2 years. What if I underwrite the underwriter, 17th of April, 2025, $5 put options are commanding a juicy $2.7. And so your effective break even will be at $2.30. So a 2/3 drawdown from here.
Yeah.
You bring
I might be the only person in the world that has confidence that they're not a zero, but I'm selling these things. Actually, I deposited more money into my account to sell more of these things. And Interactive Brokers just switched from a 2-day clearance to a 4-day clearance. And now I'm pissed off because I have to wait 3 more days before I can sell more of these puts. But especially with the take private offer at $7 and knowing what all the assets are, I feel pretty bold to write any put under $7, especially with the prices being that extreme. But I said on my Substack, look, this thing has more risk associated with it than articles that I would normally write. So I'm still in it, but please don't follow me because it's it's something that I've done all the work and I'm confident in the valuations. But just as far as a Substack writer goes, this thing has become messy. If it was this messy originally, I would have never written about it. And now that it is this messy, it's really not for the faint of heart. And it's not the sort of thing that I would get into at this moment. But knowing now, having done all the research and knowing what all the assets are, I feel confident going forward. But it's I also have the word degen in my name, so it's not for everybody.
It's true. Well, there's no risk, no reward, as they say. I tell you what is heading in the right direction. 2 things I really like. So gold, that's up all-time highs in nominal terms. Inflation adjusted terms, we still got a long way to go. Uncle Jerome's helping me out on this one. You have any exposure to gold by any of the various ways in which it can be played?
Yeah, so we might have spoken about this. So two things I really like. My gold exposures in 2 forms: Equinox Gold and Sibanye-Stillwater, and both have pretty interesting things to talk about. So Equinox Gold first. I think it was 2 quarters ago. The earnings call was a disappointment because gold had already gone to 2,300 an ounce. And they were still selling gold for 2,000 an ounce because they had locked in some forward contracts. So in order to finish building out their mine, when gold was 1,900 an ounce, they locked in forward contracts to sell it for 2,000 an ounce. As of last quarter, that's finally rolled off. So last quarter, Equinox Gold was selling gold for 2,300 an ounce. So the forward contracts that had locked in that price should be behind them. There's another accounting idiosyncrasy that caught a lot of people off guard, and I didn't even know it was a thing. But and I don't know if this is something they choose to do or if it's in GAAP accounting principles. But in the startup phase of the mine, they're booking that separately. So all of the gold that's mined from their flagship mine, the Greenstone mine in Canada, until they're at the full run rate, which is going to happen, I believe, within the next 6 months, all of that production is not considered in the operational sense. So they're not showing any improvement in lowered all-in sustaining costs. Their all-in sustaining costs have not budged, despite the fact that this mine, they claim, will produce 400,000 ounces a year at a $975 all-in sustaining cost, which at current gold prices is like $600 million of EBITDA. So the first gold pours have happened. I think it was, I think something like 15,000 ounces last month, but it hasn't shown up in reduced all-in sustaining costs yet, and it might not next quarter either. It might take 2 more quarters before they declare it's officially in operations mode, and we're going to start showing you what all the cost profile is. I mean, there's still risk that the mine doesn't perform as they think they will, but it's a lot less risk than a gold miner failing to deliver on time and on budget, because miners not delivering on time and on budget, that's a dime a dozen. But if they were just completely wrong about all of their core samples and geology, and it doesn't provide 400,000 ounces a year at $975 an ounce, that is a risk. I perceive that as a much smaller risk.
Yeah, been nasty surprise so far. I mean, Ross Beatty at the helm, and it seems to be ticking along according to plan. I know my uncle Rick is all over this one, so he's a believer. I personally am. The older I get, hopefully the smarter I get, and I just think royalty, royalty, royalty. Let me get exposure by royalties, so
Yeah.
perhaps we can talk about that another time. But Sibanye-Stillwater, they also had some recent news, had a little bit of controversy on Twitter. Let's talk
Yeah.
Sibanye-Stillwater because we both like that, and I think that we can provide some commentary around this.
I think people on Twitter just interpret everything in a negative light. I think there's just something about the atmosphere of Twitter that everything is bad, and whatever the CEO does, it's stupid. So Sibanye-Stillwater is just like Equinox Gold when gold was 1,900 an ounce. They did these forward contracts at 2,000 an ounce. So Sibanye-Stillwater has locked in some sales prices for their gold production. And I don't know off the top of my head exactly how much it is, but it's a substantial chunk. But also gold is significantly higher now.
It's 1,000. It's 1,491 kilotons. No, kilograms. I will
Yeah.
check that. Something like that.
It's a pretty good chunk of promised gold at a locked in price. But I was looking, and I'm not very good at technicals. And my thesis for gold is very bullish in the long run because it's competing money and the bricks don't want to be on the dollar anymore. So um, because of that, because it's a demand pull that's lifting up the gold price, I'm less afraid of the miners, even though miners have underperformed in all the other gold runs because that was more of a cost push increase in the price of gold. So the miners were losing money while the price of gold was rising. I think that's not going to happen this time because it's the demand pull from China and all the other BRICS countries. But if you just look at the gold chart for since last October, I mean, it's almost a straight line up. So it wouldn't surprise me if just on the technicals there's a pullback. And management at Sibanye-Stillwater, I know they get a lot of hate on Twitter, but I found them to be remarkably good at this sort of thing. So them locking in prices now and having such a strong track record of performance, I'm highly suspicious that the gold price doesn't pull back here for a while. So I definitely, and if that happens, of course, the management will look a lot smarter than people on Twitter. The keyboard warriors are mad at them, but they never want to give up any upside. And with Sibanye-Stillwater's, with the price of palladium and platinum in the toilet, they need some money coming in the door. So I'm tickled pink that they engage in this long-term contract to raise some money and to lock in that price. So we'll have to see if the price of gold, I'm long-term bullish on the price of gold, but this just the technical chart of the price rallying up to 25.50. I mean, the gold price goes up every time Kamala Harris says something, but then we'll see what happens to the price of gold if Trump wins the election, or who knows what's going to happen. But it wouldn't surprise me to see a pullback.
Yeah, in the short term, I think in the long term, it's going one way, and that direction is not down compared to dollars. So for clarity, I brought up my notes again. 1,497 kilograms of gold in equal monthly tranches. They could have been a little more clear around that. They could have said whether it's equal monthly tranches of that amount or that's the amount in total to be divided over the 2-year period. And whichever way I look at it, you're looking at essentially sort of 7%, maybe even a 15% return on this deal, depending on what happens with the rand in between times. I think it's a good deal. I think the company still is trading around the same stock price where they did that little cap raise almost 2 years ago now, or the end of last year. They have plenty of cash. Their debt is manageable. Eventually, the Russians will not be able to sell the same amount of platinum onto the market. People will realize that EVs are, kind of like my dreams of being a successful investor. They're probably a pipe dream, and so we're gonna have to use platinum and palladium in more of that catalytic conversion. Palladium has just been absolutely walloped. It's trading even below platinum now. It was over $3,000 a troy ounce. It's like 958. Um,
Well, that's the Nornickel byproduct. So the Russians would be selling palladium because I don't think they get much platinum out of their nickel mines. It's so that I mean Rick Rule said that it was probably because of Russian selling. That's what he had heard, and it very easily could be because palladium is doing much worse than platinum, and that's what the Russians are getting out of Nornickel. Now, short term or medium term, when the world gets back into automobile production in a big way, if they're hybrids or internal combustion, I think it would be really good for platinum and palladium. In the really long term, though, if the copper bulls are right, I didn't fully appreciate this until I started digging into things. So something like gold and silver, 30% of annual supply comes out of a byproduct of copper mining. But platinum and palladium, it's as high as 50%. So if copper mining doubled, which you need for a lot of the electrification of everything, well, that means the byproduct from copper would completely replace all pure platinum mining. Because you're already getting 50% as a byproduct already. But copper mines take a lot of time to come online.
I was just going to say it's been a while since we've seen a greenfield exploration turn into a copper mine.
So for the very long term, though, it's very feasible. It could be in the cards that pure platinum mining could get disrupted by, if there was enough nickel mining, if there was enough copper mining, pure platinum mining someday could get disrupted by that. That's very, very long term. Before that happens, there's going to be some big, and possibly because of the Federal Reserve cutting interest rates and people buying automobiles again, there'll be a demand spike for platinum and palladium, and it'll go to the moon. But I wouldn't buy and hold Sibanye-Stillwater for 50 years, but I'm certainly in it, for at least the next 2, 3, 4, 5. None of that scares me. But it is just worth putting it out there that half of all platinum and palladium are byproduct. So any big increase in copper mining and nickel mining would threaten that.
Yeah, that's a very good point. A very good point indeed, sir. Anything else you wish to talk about in particular, or we can riff?
Well, I gave you one of my paywalled stocks, which was Douglas Elliman, Doug.
Yes, thank you for that. That was nice. Thank you, sir.
That one's doubled. A different one of my paywalled. I have this series called 10 Bagger or Bust, and one of them did genuinely go bankrupt. One of them busted. So one of them is doubled. One of them's gone to zero. But I think we're running over an hour, so maybe I'll save my next paywalled hot tip for next time we talk, and we'll leave the viewers wanting more.
That sounds great. Let's leave it on a note of suspense. Guys, Unemployed Value Degens Substack. Make sure you subscribe. Link will be in the description. Absolute treasure chest of value. Thank you very much for watching, and I look forward to catching up with you in another episode of the ROI podcast. Then, take care, guys.